Assalamu alaikum and welcome to American Muslim Real Estate Investors Network. Alhamdulillah, finally Muslim investors can now invest in real estate within the United States in total compliance with Sharia laws and utilizing very minimal personal capital. We hope that you have watched our other presentations that are available and also have visited our website at ribafreeinvesting.com. This is a very important presentation in the sequence of presentations because inshallah in this presentation we will cover the actual strategy with you, how a Muslim real estate investor can utilize our strategy to prosper in this market. As a Muslim real estate investor, you should be considering the areas, the properties, and very important is your exit strategy prior to getting into real estate. So there are three important aspects of real estate investing: where to invest, how to invest, when to exit. Inshallah, when you utilize our services and purchase properties through our system, and we have examples of the kind of properties on our website at ribafreeinvesting.com. All these conduits are already present in that investment. So let's look at each one of these aspects of investing one at a time, and we will spend some time on each of these angles of real estate investment strategy. The first important part is where to invest. And we can call them what are the safest real estate investment markets, what are the characteristics of such market. The first and foremost, we look for population and job growth. It is critical to be in a market where the population is growing, where population is inclining, not declining. And we have also found that the population growth is directly related to the job growth in that area. At this time, we are avoiding markets or areas or towns where over 20% of the jobs are dependent upon manufacturing, because we all realize that that's the job sector that is leaving the United States. We are also looking at the second most important part in picking up the area where to invest is to look at the rent compared to the sales price. We have a formula that we use. We call it 1% rent to sales price rule. What does that mean? That means if you are purchasing a property for which the market value is $50,000. Now, in the next slide, we'll talk about how we are buying them. If it's a $50,000 property, we are buying it for $25,000. But if the market value is $50,000, the property got a rent for $500 or more. And that is critical because it affects a real estate investor in two ways. One, it affects your bottom line, positive cash flow. If you are not generating 1% rent compared to what the market value is, you will have a negative cash flow situation, and it will also not be a very marketable property. The third thing we look for is the land availability. We prefer areas that have reached their geographical boundaries. We do not invest in suburbs or outskirts. We stay in the metro areas because the kind of tenants that our properties attract, these are the working class folks. They have to have easy access to work. They have to have easy access to the freeways, and they can't afford to drive hour or 2 hours to get to their workplace. So let's talk about how to invest. This brings us to the how to invest part. What sort of properties should a real estate investor be investing in and why? The first part is that property got to have instant equity. And what kind of instant equity? If you're buying properties with cash as a Muslim investor, you're pooling your money, you're putting it together, you're buying it as a team, we only buy those properties that offer double the equity. That means if you're buying a property for $25,000, the property is worth $50,000 in that particular market condition at that time. Now, why is that important to you? Remember, when you are ready to exit the market, even if this property did not appreciate, let's assume there was zero appreciation. Let's assume the property depreciated. It was not your money that you lost. Your money, you will still get it back. So that's why it's critical to have instant equity. Second, the property got to be in the right location. What is the right location? The property got to be close to the job, amenities. Also, the neighborhood got to be okay neighborhood. We're not looking at the top class neighborhoods and suburbs because the kind of properties we are purchasing and the price we are paying, it's very hard to find properties in suburbs. But we are looking at working class neighborhoods. We are trying to avoid neighborhoods that are gang infested or have drug related crimes in it. We do our due diligence prior to closing on the deal to make sure we are in the right location and we avoid the bad areas. We are also trying to avoid projects, as we call them. We only want properties that will have a minimal maintenance. That means that we don't have to replace major items in them. If there are major items need to be replaced, we will have enough money in the money that we had collected from our investors to do those repairs. So we don't have to worry about them for the next 5 to 10 years. Prior to closing on a property, we do full due diligence on the property condition. And we do it by hiring a professional property inspector, making sure that there are no major flaws in the property. And if there are, we will know about them prior to closing on them. Now that brings us to the last point. To understand the exit strategy, this is probably, in my opinion, very critical part of being a real estate investor. We need to get started by understanding that real estate always is in cycle. There's an up cycle and there is a down cycle. Right now, towards the end of 2008, we are big time in the down cycle of real estate. That's why it's perfect opportunity to purchase properties, because it is my personal opinion as a real estate investor coach that the properties have to be bought in down cycle and sold in up cycle. The marketability of property is also important. What do I mean by marketability? If you're buying an apartment complex, when you're ready to sell, you have to sell it to another real estate investor. But if you are focused on a single family home, a very a ground up opportunity, starter home, you can go either way. You can sell the property to a home owner or home buyer. You can a first time home buyer. You can also sell a property to a real estate investor. So it is important, if you're purchasing a property that is most expensive in the area, you're going to have a hard time selling it. So we only go for properties that are priced towards the bottom. They're the cheapest house in the neighborhood kind of a deal. We avoid buying bigger properties. We want the property that is easily sellable when the time comes. And another thing you need to look at is what will be the tax consequences. Now, if you're a real estate investor or investor in general, there are tax consequences on capital gains. But as a real estate investor, you can do 1031 tax deferred exchange and take the money, the profits made, and roll it into another investment. Inshallah, if you have questions about that, talk to your accountant. Also, you can talk to us. The next slide will be giving you information how to contact us, and we can go over some of these, how to avoid the tax liability, how you can defer the tax liability, inshallah. You can contact us through different methods. You can do it via email or phone number that is listed on your screen right now. But we also encourage you to visit our website, and you can contact us through our website, ribafreeinvesting.com. I thank you for spending your valuable time with us, and I am hopeful that you learned something new. Jazakallah khair. Until next time, take care.